Rolex is not just a watch company, it is an economic sensor. And right now, something crazy is going on with the economy. The question is, are you paying attention? To understand what is going on, let's unravel the perception of Rolex and the reality of Rolex. The pressure gauge nobody uses. Most people look at Rolex and see a watch. Economists should look at Rolex and see a dashboard. Here is why. A luxury watch, unlike a stock, cannot be shorted. Unlike a commodity, its price is set by genuine demand from real buyers, making genuine discretionary decisions. And price isn't set by algorithms, institutional funds, rebalancing portfolios, or central bank intervention. When the secondary price of a Submariner rises, it means that real human beings with real money feel confident enough to part with it for an object that does nothing except tell the time and signal their circumstances. When it falls, it means those same human beings are pulling back. Not because the watch changed, because they changed. Run the secondary Rolex market data from 2019 to 2026 alongside consumer confidence numbers for the major luxury markets. They track each other with uncomfortable precision. In 2019, steel sport Rolex prices were elevated but rational. Premiums ran at 20 to 30% above retail. The economy was growing steadily. Consumer confidence in the United States, Europe, and China was healthy. The Submariner at that premium was an aspirational purchase for the person who had been saving, or a comfortable discretionary purchase for the person who had not. Either way, the premium was sustainable because the economic environment that produced it was real. In 2020, the pandemic hit, supply chains froze, and Rolex's own production was disrupted. The secondary market briefly compressed, and then, as stimulus money arrived and interest rates were driven toward zero, something unusual happened. An entire generation of buyers with locked-down savings and nowhere to spend them discovered that a watch held its value better than a savings account earning nothing. That was true. And then it became a narrative that attracted buyers who were not actually interested in watches at all. By 2021, the Submariner was trading at double retail. The Daytona was touching $45,000. The GMT Pepsi hit $25,000. These were not watch prices. These were speculative asset prices wearing a watch case, supported by cheap money, rising equity markets, and a collective belief that everything only went up. The Rolex gauge was reading an extraordinary economy. The economy was, at that point, genuinely extraordinary, or at least it felt that way while the free money lasted. Then, interest rates rose. The cheap money stopped. The equity markets corrected. The speculative buyers who had entered the Rolex market because it was the easiest trade available started looking for the exit, and the Rolex secondary market, because it cannot be managed, cannot be padded with quantitative easing, cannot have its price discovery suspended by a regulator, started shaping up in a brutal way. The gauge is a leading indicator. It moved before the headlines did. It is moving again now. By 2025, the Daytona was at 35,000 used, still above retail, but down from 45,000 at peak. By early 2026, some gold models were trading below the price of a new one from an authorized dealer. The steel Submariner, the benchmark against which every other movement in this market is measured, held a premium of 10 to 20% real, but a fraction of what it commanded in 2021. These are not numbers from a collapsing brand. Rolex sold an estimated 1.1 million watches in 2024. Revenue crossed 10 billion Swiss francs for the first time. By every measure of the business itself, Rolex is performing. The gauge is not reading a brand in trouble. It is reading an economy in which the buyers around that brand are under pressure. There is a significant difference between the two readings, and conflating them is where most commentary on this subject goes wrong. The brand is fine. The buyers are not. And in a market where secondary prices are set by buyers rather than brands, the buyers are the ones who matter. What changed between 2021 and 2026 is not the watch. It is the economy the watch lives inside. And understanding what specifically changed, the three forces that hit simultaneously, the signal from China that Western coverage missed, and the strategic response that looks wrong on the surface, is the only way to read what the gauge is telling you about where things go next. But before we talk about the economy, we need to understand the mechanics. Three forces hit Rolex simultaneously in 2025 and 2026. Any one of them alone was manageable. Together, they changed everything. Three forces, 1 year. In the 12 months between January 2025 and January 2026, three things happened to the Rolex price structure simultaneously. Each one alone was a weather event. Together, they were a structural storm. Force 1, gold. Gold surpassed $4,400 per ounce in late December 2025. To understand what this means for Rolex, you need to understand that Rolex runs its own in-house foundry. They smelt and alloy their own gold rather than sourcing it from external suppliers. This means rising gold prices hit Rolex's cost structure immediately and directly. There is no hedging buffer, no supplier contract to insulate them. When gold goes up, Rolex's gold watches become materially more expensive to produce within weeks. Gold rose approximately 70% in the 12 months ending January 2026. That is not a marginal cost adjustment. That is a structural repricing of every precious metal model in the catalog. Force 2, the dollar. The US dollar weakened approximately 12% against the Swiss franc over the same period. Rolex prices are denominated in Swiss francs at the source. Every Submariner, every Daytona, every GMT is priced in CHF before it touches US soil. When the dollar weakens against the franc, the same watch costs more dollars, not because Rolex raised the price, but because the currency math changed. American buyers were effectively paying a 12% surcharge that did not appear on any invoice. Force 3. The tariff. President Trump's administration levied tariffs on Swiss luxury goods in 2025. The initial rate was 10%. By August, it had risen to 39%, after what Gear Patrol reported as informal negotiations, which included Rolex inviting Trump to the US Open and gifting him a gold clock, and which Swiss lawmakers subsequently investigated as a possible bribe. The tariff settled at 15%. Rolex absorbed the tariff rather than passing it through as a line item, folding it instead into the January 2026 price increase. Three separate forces, three separate origins: commodity markets, currency markets, trade policy. Each one a different system, a different set of actors, a different chain of causation. All three landing on the same watch brand in the same 12 months. The result is three price increases in 1 year. January 2025 at 5%, May 2025 at 4% to absorb the initial tariff, January 2026 at 7% average, with gold models running at 8 to 9%. Cumulative impact is roughly 16 to 17% in 12 months for the typical American buyer of a precious metal reference. For a gold day date that started the year at $47,000, that means paying roughly $8,000 more at the end of the year than at the beginning for the identical watch. And yet, the secondary market did not rise to match. For steel references, it held modest premiums. For gold references, it fell significantly. The price a buyer would pay in the real market, outside the authorized dealer system, moved in the opposite direction from the price Rolex set for the official channel. That contradiction is the gauge reading. Three forces pushed retail up. The economy pushed the buyer's confidence down. The secondary market, which cannot be managed from Geneva, which cannot be influenced by a press release, which is settled by the individual decisions of thousands of people making independent financial calculations, recorded the net result. Before we get to what the China data adds to this, have you ever looked at a Rolex secondary price as an economic signal? Or do you just read it as a watch price? Drop it below. I want to know how this audience actually reads the market. One piece of the story is almost entirely absent from the English language watch press. The second largest Rolex market in the world, China. The signal from Jihu. Chinese luxury consumption peaked in 2021 and began contracting in 2022 before beginning recovery in 2023. The contraction was documented in financial reporting and was visible in quarterly results from Richemont, LVMH, and the Swatch Group. What was less visible in English-language watch coverage was its specific impact on Rolex, because that impact was moving through channels the Western press was not watching. Chinese collectors who bought Rolex at gray market premiums in 2021 and 2022 made the same calculation as buyers everywhere. This is a liquid asset in an environment where traditional stores of value are uncertain. Chinese property markets were under severe stress from the Evergrande collapse and subsequent regulatory intervention. The stock market was volatile. Capital controls made international asset allocation complicated. A Rolex was portable, internationally recognized, and denominated in the most prestigious brand in luxury, a kind of universal certificate of value that crossed borders. The hype worked while premiums held. When premiums began compressing globally from their 2022 peak, Chinese holders faced the same pressure everyone else faced, but in worse circumstances. A Chinese collector who bought a Submariner at double retail in 2021 and is now selling at a 15% premium over retail in 2026 has made a 5-year investment that underperformed a savings account. In an economy where consumer confidence was already under pressure from property market weakness and youth unemployment above 20%, the impulse to exit a depreciating discretionary asset was strong. The selling moved primarily through Zhihu discussions, WeChat groups coordinating pricing and buyers, and Xiaohongshu listings that operate outside the Western gray market infrastructure. By the time this supply pressure showed up in English-language Chrono 24 listings and Watch You Seek threads, it had already been building for months in channels the Western watch press was not monitoring. This matters for one specific reason. The traditional model for predicting Rolex secondary price movements assumes that supply is relatively constant and that price movement is driven by demand fluctuations. That model fails when a major source of supply, Chinese collectors liquidating peak price purchases, adds significant volume to the market through channels that do not appear in the standard Western data sources. The secondary market compression happened faster than most Western analysts expected. The reason was not only that demand softened. It was that supply increased from a direction nobody was watching. The gauge recorded it. The commentary caught up months later. The question of what happens next in the Chinese market is meaningful for anyone trying to forecast Rolex secondary prices over the next 12 to 18 months. Chinese luxury demand has historically been cyclical. It contracted in 2015 to 2016 during an anti-corruption campaign, then recovered strongly. Whether the current contraction represents a similar cycle or a more structural shift is genuinely unknown. What is known is that until that supply from Chinese liquidations clears the market, the downward pressure on steel sport references will continue even if Western demand stabilizes. So, what does this mean for the specific models you might be watching? The data divides the catalog in a way that tells two completely different stories. Steel and gold, two different economies. The 2026 Rolex market is not one market. It is two markets sharing a brand name, and they are behaving differently enough to require separate analysis. Understanding which market you are looking at changes everything about how you read the current situation. The gold market, the failed hedge. Gold references, day date, gold Daytona, gold Submariner, gold GMT attracted a specific buyer profile between 2020 and 2022. These were not primarily watch enthusiasts. They were buyers who understood the gold content of the watch as an inflation hedge, combined with the Rolex premium as an additional store of value on top of the metal value. The thesis was coherent. Gold price rises, watch value rises with the commodity. Rolex premium watches hold an additional layer of appreciation. Two independent drivers working in parallel. The thesis failed when both drivers moved against the buyer simultaneously, but in different ways. Gold itself rose, from roughly $2,600 per ounce at the end of 2024 to over $4,400 by late 2025. In theory, this should have supported gold Rolex prices, but Rolex's retail prices rose faster and further than the secondary market was willing to follow. The white gold Submariner 126619 saw its retail price rise by more than $4,000 in the 2026 increase alone. That price increase meant that the gap between retail and used did not close. It opened. The secondary market, looking at a used watch that now competes with a new one that costs $4,000 more, should have risen to match. Instead, it stayed where it was, because the buyers who would have paid more for the used watch were the same buyers under broader economic pressure. The result: you can now buy a lightly worn gold Submariner for less than the retail price of a new one. The all-gold Submariner 126618LB was trading in the secondary market at around $55,000, roughly $10,000 below what an authorized dealer charges for a new one. The buyer who paid $63,000 for one in 2022 and is selling now is realizing a loss measured in tens of thousands of dollars. Not because the watch broke, because the thesis broke. The steel market, still standing, but changed. The steel sport references tell a completely different story. And this is important to understand because the steel market is the one people actually mean when they talk about the Rolex market. The Submariner 124060 now retails at $10,050. In the secondary market, it trades at around $11,000 to $12,000, a 10 to 20% premium. That premium is real. The demand is real. The scarcity is real. But compare it to the 50 to 60% premium of 2021, and you are looking at a watch whose speculative layer has been stripped away, leaving the underlying genuine demand. The genuine demand is enough to hold a modest premium. It is not enough to generate the extraordinary premiums that attracted the speculative buyers who then had to exit, and their exit compressed prices further as they sold, which is how markets clear. The steel market is telling you the enthusiast and the aspirational buyer are under pressure but present. They have not left. They are paying a rational premium for a watch they actually want to wear. The market has deflated from absurdity to something closer to equilibrium. These are two completely different economic signals. The gold market is a signal about the failure of an investment thesis. The steel market is a signal about the durability of genuine desire under economic pressure. Both are worth understanding. Only one of them is actually about Rolex. Now, here is the part that feels counterintuitive. Why did Rolex raise prices into a compressing market, and why was that the right move? Why Rolex raised prices when it should have held? When secondary market prices compress, conventional business logic suggests easing retail pressure to maintain demand. Do not make the new product less competitive versus the used product. Give the buyer a reason to choose new over pre-owned. This is how most consumer goods brands behave in a soft market. Rolex did the opposite. They raised retail prices into a compressing secondary market 3 times in 12 months. And this was not a mistake. It was one of the most sophisticated brand protection moves in luxury goods. Consider what happens to the Rolex holds value narrative, the single most powerful selling proposition in the watch world. If retail prices stay flat while the secondary market falls, if retail is $9,000 and a lightly worn Submariner sells, used for $7,000, that is a 22% depreciation. Every forum thread, every YouTube video, every conversation between an aspiring buyer and an existing owner now includes the sentence, "I bought mine for $9,000 and it's worth $7,000 now." The narrative that separates Rolex from every other luxury purchase in the buyer's mind does not just weaken, it inverts. The watch that was supposed to hold value now demonstrably lost it. By raising retail to $10,050, Rolex changed the arithmetic. A used Submariner at $9,500 is now 5% below retail, not 22%. The absolute dollar gap between what the original buyer paid and what the secondary will bear is the same, but the story you tell about it is different. 5% below retail on a pre-owned example is good value secondhand. 22% below retail is Rolex lost me money. One of those sentences is survivable. The other is an existential threat to the brand's value proposition. There is also a second function to the price increase that matters independently of the secondary market: genuine cost justification. Gold rose 70% in 12 months. The dollar weakened 12% against the franc. A 15% tariff was absorbed into retail pricing. These are real costs that a company with Rolex's manufacturing structure cannot absorb without passing through. The January 2026 increase was not purely strategic, it was also necessary. The two motivations are not in conflict, they are aligned. Rolex needed to raise prices for cost reasons. And raising prices also served brand protection. A brand that raises prices when it needs to, for credible reasons, while competitors hold flat, does not look desperate. It looks like a company confident in its own demand. The confidence signal is not nothing. The buyers still on the wait list, and there are still wait lists for the most desired steel references, need to believe that the decision they made 2 years ago to put their name on a list is still the right decision. A price increase says the brand agrees. You made the right call. The irony is that the mechanism that protected the brand's narrative is the same mechanism that accelerated the gold market's collapse. Higher retail prices meant gold references moved further above used pricing, which meant buyers of used gold Rolex looked at the alternatives and chose used, which added more supply, which pushed used prices lower. The steel market was protected by the price increase. The gold market was accelerated toward its correction by the same decision. So, what do you do with all of this? What does the gauge reading actually mean for someone making a decision about Rolex right now? Before we move on to the next part, let me tell you this. Most people don't realize this, but buying a watch the wrong way can cost you thousands, and you won't even notice it until it's too late. You walk into a store or browse online, and everything looks the same, but behind the scenes, there's a system. Prices aren't always fair, availability is controlled, and one bad decision can leave you overpaying for something that doesn't even hold its value. That's why I created a complete free insider guide to buying watches. Inside, you'll find the best watches to buy, the watches to avoid, and how to choose a watch that actually fits your style and budget long term. The goal is simple. I'll help you stop guessing and start buying smart. You'll find the free guide in the pinned comment and description. Now, let's move on to the next part, what the gouge is reading. The Rolex secondary market in April 2026 is telling you the following, if you know how to read it. The speculative layer has been stripped out. The buyers who entered the Rolex market between 2020 and 2022 because it was the easiest speculative trade available, buy at retail, sell at double retail 6 months later, are no longer in the market. They left when the premiums compressed below the point where the trade made sense versus any other use of that capital. Their exit added supply to the secondary market during a period of softening demand, which is precisely why the correction felt faster and steeper than people expected. When speculators exit a market, they do not exit slowly. They exit as fast as they can before they are the last one out. The exit is largely complete. The remaining sellers in the secondary market are enthusiasts managing their collections, dealers managing inventory, and Chinese holders still working through their positions. The speculative volume that inflated prices is gone. What remains is the structural demand, the genuine, durable desire for Rolex watches from buyers who actually want to wear them. That demand is real. It supports premiums that are lower than the bubble peak, but positive. The secondary market is not broken. It has deflated to a more honest level. Consumer confidence in the target buyer is under pressure, not broken. The target Rolex buyer, the professional in their 30s or 40s, upper middle income, making a significant discretionary purchase they have thought about for years, is navigating an economic environment that is objectively more difficult than 2021. Higher mortgage rates, higher borrowing costs, equity portfolios that have not delivered 2021 returns. In some markets, job security concerns. This buyer has not disappeared. The steel Submariner still commands a premium. The wait lists for the most desirable steel references still exist. The demand is present and documented, but the buyer is more careful. They are less likely to pay above the secondary market price. They are more likely to wait for a deal, to buy used rather than new, to defer the purchase to a quarter when their personal finances feel stronger. The yellow light reading, "Caution, not stop," holds. The tariff situation is the most unpredictable variable. The 15% tariff rate that produced the January 2026 price increase is not guaranteed to hold. The Trump administration has demonstrated willingness to use tariff rates as a negotiating instrument, raising them to 39% on Swiss goods before accepting 15% after what multiple reports described as direct Rolex lobbying. A future escalation to 20, 25, 30% would trigger another retail price increase with no corresponding secondary market movement. Each such increase widens the gap between retail and used and makes the used market more attractive relative to new. The Rolex authorized dealer model, which depends on retail purchases to maintain AD relationships, is specifically threatened by a scenario where rational buyers consistently prefer used at a discount to new at a premium. What the next 12 to 18 months look like from here? The steel Submariner will likely be at a price above $10,050 in 18 months. Whether through annual price increases, tariff absorption, or currency movements, Rolex retail pricing has a persistent upward trajectory that has not been interrupted by market corrections in living memory. The question is not whether it will cost more. It is whether the secondary premium will move with it. The gold market will remain under pressure until Chinese liquidations clear and until interest rates move in a direction that makes gold content assets attractive as hedges. Again, neither condition is predictably close. The China variable is the one most worth watching. If Chinese luxury demand stabilizes or recovers, driven by policy stimulus, recovering property values, or renewed consumer confidence, the supply overhang that has been pressing down on steel references will diminish. The gauge will move. When you see Chinese luxury consumer data improving, watch the Rolex secondary market in the following quarter. The correlation is documented and the lag is short. The headline said, Rolex slashed prices. The data says something more nuanced. Rolex is a pressure gauge sitting inside an economy under pressure, and it is doing exactly what it should do, reading the pressure honestly. Rolex did not slash prices. The headline lied to you, and I told you so in the first 30 seconds. What Rolex actually did was raise prices by 16 to 17% in 12 months, while the secondary market moved in the opposite direction. The gap between those two facts, retail going up, used going sideways or down, is the story. And the story is not about Rolex. It is about the economy that Rolex lives inside. Three forces hit the brand simultaneously in 2025 and 2026. Gold at $4,400 per ounce, up 70% in 12 months. The dollar fell 12% against the franc, the currency in which every Rolex is ultimately priced. A 15% tariff on Swiss luxury goods absorbed into retail pricing after informal negotiations that Swiss lawmakers found worth investigating. Any one of those three forces alone was manageable. All three in the same year produced a situation no watch brand had navigated before. Retail forced upward by real costs. Secondary, resisting the upward move because the buyers who set secondary prices were under economic pressure themselves. The China signal made it worse. Chinese collectors, who bought at speculative premiums in 2021 and 2022, began liquidating through channels the Western press was not watching. Supply increased from a direction the standard models did not account for. The compression moved faster than analysts expected and is not fully resolved. The gold market told you one story. An investment thesis failed. The buyers who entered the gold Rolex market as an inflation hedge strategy discovered that the hedge required other buyers to maintain it, and those buyers left simultaneously. Gold references trading below retail are not a Rolex failure. They are a market-correcting and overpriced asset back to a price that reflects genuine desire rather than speculative demand. The steel market told you a different story. Genuine desire is remarkably durable. The Submariner still commands a premium. The waitlists still exist. The buyer who wants to wear a Submariner, who has been saving for it, who has been on a list, is still there. Under pressure, perhaps. More careful than in 2021. But there, the steel market's modest positive premium is one of the most honest economic readings available. It says that even in a difficult environment, genuine aspiration holds. What Rolex raised prices into was not a failing market. It was a correcting one. The raising was both necessary, real costs demanded it, and strategic, because the alternative was a narrative collapse that would have been far more damaging than any secondary market movement. The economy is not done. It is under genuine pressure from forces that are not short-term. Tariff uncertainty, currency volatility, Chinese structural adjustment, the end of the free money era that inflated every speculative asset simultaneously. Rolex, which survived the quartz crisis, survived the 2008 recession, survived every market cycle since 1905, is not at risk. The brand is too strong. The product is too good. The manufacturing discipline is too consistent. 3 to 5 years from now, the steel Submariner will cost more than it costs today, and the secondary premium will likely recover as the speculative dust settles and genuine demand reasserts itself without the noise of speculative buyers adding and removing themselves. The watch did not change. The world it lives in did. The gauge is reading it honestly. That is what it does. So, which are you buying, holding, or watching from the sidelines right now? Are you bull or bear on the Rolex market in 12 months? Let me know in the comments. Like this video and subscribe.